All right, so what we're going to do is discuss and talk about in this video is going to be specifically around changing the policy from annual payments to monthly payments and how that changes the performance of the policy. The big takeaway is if you want to pay annually, you can pay annually. If you want to pay monthly, you can definitely pay monthly as well. There's just going to be a slight nuance between them and why one is more efficient than the other. Annually is going to be more efficient because the insurance companies charge you an expense charge for every time a payment is essentially processed. So if you do monthly, that's 12 months. Essentially, there's going to be a processing fee from the insurance company that they're going to charge you for having that monthly payment on. So if you can pay annually, which is what we encourage all of our clients to do, is to pay annually, highly encourage you to do that. The payment can be as high as like 9.6%. So if you're paying on a monthly basis, depending on the company that you choose. And we're going to go ahead and take a look at these numbers specifically with this company on how the policy performance changes, keeping everything exactly the same, apples to apples to the T, nothing different. One thing different, that's going to be paying either monthly or paying annually. So this policy is the policy we've been using for every single video in the series up to this point. And you're going to see nothing has changed. Female, age 35, super preferred, high cash value, 92% year one, break even point. Break even essentially means having more cash value than the money you put in. You put in 250, you have 250, 782. We have more cash value to borrow against than the money that we put into the policy. Happens in year 4. Very, very, very high performing policy. Now, all we're going to do is just change it to monthly and we're going to take a look at the difference. So looking at monthly, you'll now see that there's 91.8% liquidity in year 1. And then when it comes to the break-even point now is year 5. So it's changed from year to year, and the amount of cash value that you have in difference from year 5 here to year 5 here is about $4,000. So earlier on, it doesn't make that much of a difference, right? So if you're like in year 1, you're like, hey, I can only do monthly right away. Well, if you do monthly year 1, the difference in between the two is just going to be a couple $100s, right? We're seeing it here. But if you do monthly long term, you can now see when it starts to pay dividends, no pun intended, policy annual dividend. I don't mean anything dividend related to this. Obviously, you do get a dividend, so on and so forth. But back to the subject, it is going to pay tremendously to pay annually long term than paying monthly, because if you keep paying monthly, you'll see that, we talked about year 5 just being the difference of a $4,000 difference. But what happens when we start getting later on? Like when we're looking at the policy and we're looking at essentially year, let's go to year 16. There's essentially going to be 1.1 million, 1.15. And then when we start looking at this one, 1.42. So the difference between that is essentially going to be $15,000 difference. $15,000 difference is a big deal over a period of time. What could you have done with $15,000 extra dollars? What would that $15,000 earn you if you borrowed against it and put it into a deal? Real estate, something you believe in from an asset-based activity, your business, crypto. I mean, there's so many things that you can obviously invest in. If you had $15,000 and put it somewhere else, and let's just say it got you 15% rate of return, because you are your greatest asset, you have the knowledge, you have the whereabouts to go out and produce that type of activity. Well, what did you just miss out on? Lost opportunity cost. Put in the future value calculator, $15,000. What does that do? You'll be drastically surprised. You're like, wow. So I'm not saying at the end of the day you have to pay annually, but we do encourage all of our clients, if you have the ability to pay annually, it only makes sense because you will have more cash value at the end of the day. So I hope this helped. Hope give you some clarity in regards to if you can pay monthly, if you can pay annually, you can do both, but we encourage you to annually. And into the next video.
Hey, I want to thank you so much for watching this video to the end. This video is on life insurance, and if you have more questions about life insurance, infinite banking, why you should overfund it, we have a link below that goes to our And Asset Vault. This is a free vault that gives you everything you need to know about life insurance. We have case studies, we have a calculator on there, we have a handbook, we have frequently asked questions, we go through a process. I have my masterclass on there. We literally want to be the one-stop shop for every life insurance decision. And so if you want to learn more, click the link below, and we look forward to educating and maybe opening your mind and eyes to the power of life insurance.